This is John Kamarianos with Capital Considered. We are delighted to have as our guest Bill Bengen today. Bill is a legend in the investment management and financial advisory community for having discovered the 4% rule, or maybe now revised to 4.5%, which so many advisors use to help their clients distribute their assets in retirement. Bill, thank you so much for joining us. We really appreciate it.
John, my pleasure. Thanks for the invitation.
Sure thing. So, Bill, let's kick it off with a little background. I think you are a Brooklyn boy. You grew up in Brooklyn, as did I, so we have that in common.
That's right. You're talking to me.
That's right. I'm talking to you. And then you, I believe you went on to MIT, and there we parted ways because although I have some math skills, I'm not sure they're quite at that level. And you became a rocket scientist and even wrote a book on rocket science, and then somehow made the transition to financial planning. Talk about that a little bit. How did all that happen?
Well, when I went to MIT, I was really interested in doing planetary exploration. I wanted to do that whole Matt Damon thing on Mars, that movie, The Martian. That's how I envisioned my life unfolding. But as I got into my senior year and, the Apollo program was about to start moon landing, I realized that it was just funded for a few years and then it would die. And there didn't seem to be much beyond that. And it didn't look like there was any hope of getting to Mars or Venus or any of the other planets. So I reluctantly gave up hope for that career, and I did what I swore I'd never done my whole life. I joined the family soft drink bottling business, which I'd worked. It really had been my family for so long, since 1887, that I grew up in it, worked in it in the summers. 7-Up was our major brand. If you cut my veins, I would have bled 7-Up green. That's how much ingrained it was in our family. Yeah. And I joined that business and learned a lot. Learned a lot about business, helped computerize the business, ultimately helped the business expand, add some new brands. But along the way, I recommended to the family that we sell the business. I felt we had fallen too far behind our competition. So in the 100th year of the business, we sold it. Mm-hmm. And then I moved out to California and cast around for a third career. Yeah. And found financial advising, fee-only financial advising, which I loved, working out of my home. No commute after doing that in New York for so many years. That was great. And then, about 5 years into a financial planner, I started doing this research on, withdrawing money during retirement, and that gave birth to the whole 4% rule, which, has blossomed into something I never imagined.
Yeah.
And finally I retired from financial advising, but I continued the research. So I'm 30 years into it and still counting. No plans to retire from that role.
Great. And I think I've heard you say to other interviewers that you first got into this investigation of what is the safe withdrawal rate because you were trying to help your own clients and there was really no information on that.
That's right. I when that issue started to manifest itself in my practice and clients are asking these questions, I couldn't find good answers in any sources. Books, magazines, fellow advisors, no one seemed to have. And I just realized, gosh, this is really so new for the profession. No one really knows the answers. So I decided to go out and find them for myself and, got a book of investment returns, inflation, and fired up my Lotus 1, 2, 3 spreadsheet. The early 90s. That was the big deal back then for spreadsheets. Right. And sat down and started working very slowly at first with very limited objectives. But over the year, my research has just grown enormously and expanded and covered a lot of things I never anticipated looking at. And the first paper I wrote back in 94, you mentioned, the 4.5% rule. That actually generated a number of 4.15%. And that was a number I never intended to be a rule. I never intended it to be used by everybody. It was intended to be really a worst-case scenario. It applied to just one retiree out of the hundreds I was studying. It was a situation where historically, if you picked that number, your money would have lasted 30 years no matter what conditions you ran into. So it was safe from a historical, super safe. But probably too safe from the perspective of most retirees who could afford to take out a lot more. Since then, I've upgraded that to 4.7%. Still super safe number. I think today's retirees could probably take 5.25, 5.5, even though we're still facing pretty adverse conditions, with very high stock market valuations.
Explain why you upped it to 4.7, and explain something about the conditions we face today.
Sure. First part, as my research progressed, the first time, my first research paper in 94 was based on just 2 investments. And that is hardly a diversified investment portfolio by modern standards. And in 2006, I wrote a book, added another asset class, that bumped it up to 4.5, which was great. Then a couple of years ago, I added 4 more asset classes, but that just bumped it up to 4.7%. So I suspect we're kind of reaching the point of diminishing returns. We're not going to get that much benefit from adding more asset classes like gold, precious metals, real estate, commodities, and so forth.
They probably don't behave differently. They don't behave differently enough, maybe, to allow an investor to take more money out of their account in retirement.
Yeah, you'd hope so, but after a while, you get so much stuff in there. They start fighting each other rather than helping each other. Yeah. And that's the delicate balance, that we may be near the equilibrium point for that.
Yeah. We'll get to the second. The second one was current environment, but let's dwell a little bit on the original study. Sure. You mentioned you started with 2 asset classes, just good old U.S. stocks or large cap stocks and intermediate term investment grade bonds. And you ran studies that showed, no matter what happened, you couldn't run out of money, or you wouldn't run out of money taking this rate of taking this investment out, this 4% out of your portfolio over time. Talk about what the worst moment in that study was, or the worst period of time. Many people think it's the 30s, but I think it isn't. Is that right?
You're absolutely correct. Instinctively, you'd feel that it would be the 30s because of the terrible depth of the bear market. 1929 to 1932 was 90% down. We haven't seen anything like that since then, thank goodness. But when you take a look at the 1960s, the withdrawal rates are even lower. For example, the withdrawal rate for the 30s was somewhere around 5.5% to 6%. And in the late 1960s or early 70s, you had a bear market which was around 50% down. Yet, that had a much lower withdrawal rate. And the reason is that the 4% rule, or the 4.7% rule, is based upon annually increasing your withdrawals by inflation, just like Social Security. You give yourself a cost of living adjustment. And when inflation is high, those increases each year become huge, and they chip away at the portfolio. Back in the 1930s, you had the opposite situation. You had deflation. So each year, your withdrawals were declining by 10%. Wouldn't we love to see the price of things come down by 10% a year right now? Yeah. It doesn't look like it. But that was the reason for the difference. You have to consider not just what's called a sequence of return risk, which is basically how early in your retirement did you get hit with a bad bear market, but how early in retirement did you get hit with bad inflation? They're both very, very important.
So you have to contend with 2 things, really: investment returns and also the rate of inflation.
That's correct.
Whether those returns can keep up with inflation. And so, lo and behold, you revised it, I think, in 2006 in an article for Financial Advisor magazine. Talk about that, how that development of the rule came, and the additional research you did.
And I actually did a book at that time. What happened, I added a 3rd asset class. I added U.S. small cap stocks, and they've got some of the highest investment returns around, about 12% over the long term. So when you throw those into the mix, they really supercharge things, and that made the withdrawal rate jump from 4.15% to 4.5%, which is very nice, nice to see that, and didn't change it again until about 15 years later when I added 4 more asset classes and got a modest increase.
Right. But you added some things, and maybe this question can lead into the current situation. I think in that 2006 article, you mentioned that some adjustment of the portfolio could be helpful depending on how stocks are valued, so something like the Shiller PE for valuation of the stock market, and also taking into consideration the rate of inflation could cause you to adjust your portfolio in some way. Is that a fair characterization?
Yeah, I was actually able to develop a statistical relationship between the safe withdrawal rate, which I call safe max, and those two factors. It's between 80 and 85% confidence, which is not bad. Because prior to that, we really had no means by which to access those much higher withdrawal rates that retirees in the past were able to enjoy. Once again, 4.7% is the lowest for all the hundreds of retirees I studied. If you look at the average for all those retirees over the last 100 years, it's actually 7%. And that may be very surprising to most people because they're constantly thinking of that very low 4% area. The average is 7%, and some lucky retirees were able to get away with double digit, up to 16%.
Yeah.
A lot of that depends upon the circumstances, and they're closely related to when you retire, how is the stock market valued, which is related to how soon you expect a bad bear market, early retirement, and then also inflation and its effect upon your withdrawals.
So let's talk about that now. We have, by most accounts, at least an expensive U.S. stock market, maybe not overseas markets, but U.S. stock market. I think the current Shiller PE, I haven't looked in a little while, but it's in the mid or high 30s. That's not low. And then we had a bad bout of inflation in 2002. I think we reached 9% year over year on the CPI in the summer of 2022. But that seems to have subsided, although getting back down to 2% may not be in the cards or may not be easy. Where do we stand now, and how should someone retiring this year, next year, or in the very near future think about those things?
That's a tough question for a researcher like me to answer because I rely upon historical data. Yep. And there are very, very few data points, very few retirement dates in the past where we had this combination of inflation, what I would call moderate inflation, and extremely high stock market valuations. Probably late 90s, early 2000s will be the last time we got into the zone. And if you look at those periods of time, they had withdrawal rates around 5.25% to 5.5%. So that's what I would probably recommend that a current retiree look at. I don't think they have to get, as desperate as 4.7%. I don't think we were yet in a 1968 kind of a situation or 70s. Okay. Not to say we couldn't get there or it could get worse. If inflation really gets sticky and gets to a high level, all bets are off.
And what are the other asset classes now that you're recommending in addition to U.S. stocks, intermediate term bonds? You said you added small caps for the 2006 study. What else? I assume foreign stocks is in there?
In addition to U.S. large cap stocks and U.S. small cap stocks, I've put to work U.S. mid cap stocks, U.S. micro cap stocks, and international stocks. And in the fixed income area, I've added Treasury bills as a proxy for cash, which, I think you need to keep a decent percentage of cash in your portfolio at all times so you don't have to sell investments constantly to fund withdrawals.
And happily, cash is yielding something now, which it hadn't for many years after the financial crisis.
Well, yeah, getting 4% or plus on your cash is very pleasant. It was very ugly there for years where you got practically zero. You didn't know where to turn. A lot of people got, lured into stocks. Well, of course, they've done well as a result of that. But usually in the long run, it's dangerous to get to follow that kind of strategy where you buy an asset simply because it doesn't appear to be any alternative.
In the original study, maybe we've jumped ahead a little bit, and we can give investors a little more information about this.
Sure.
You were looking at portfolios between 40 and 70% stock exposure, I think. Is that right?
Yeah, actually, I looked at the whole range, and it turned out between 40 and 70% and currently it's between 45 and 75% in equities, is pretty much optimal. And it, strangely enough, it really doesn't make much difference where in that spectrum you choose to land. 60%, 45% stocks, 70%, you're going to end up with approximately the same withdrawal rate. It's just the way the dynamics of the system have worked historically. But if you go below 45% and you start have much heavier bond concentration, the portfolio just doesn't have enough oomph. It doesn't generate enough return, to get you a higher withdrawal rate. So withdrawal rates fall. And if you get too high, like an 80% stocks, then your portfolio becomes subjected to severe declines in a big bear market, and it may not recover adequately to generate the withdrawal rate you'd like to have.
Yeah. And if I can ask, where is your portfolio right now? How are you allocated?
Well, it's an interesting question. I used to be a buy and hold investor, and my research is based upon that because it's really hard to analyze something in an alternative manner. But some years ago, I became really concerned about what was happening with these huge bear markets we were getting. We had in 2000 a big one, then 2008 a monster. So I, in retirement in particular, converted to what I call a risk management approach. I have a third-party service I subscribe to that assesses risk in the market, stock market, on an ongoing basis and recommends changes to your equity allocation based upon perceived risk, up or down. And they've got a great track record, so we're very comfortable. Right now, they're recommending holding about 58% of what you would normally hold in equities. So if you would normally hold, let's say, 60% in equities, they'd be recommending hold about 35% with the rest in cash, treasury bills. And that's where I am.
So almost, if you're a 60-40 investor, they're kind of recommending half the allocation
close
to stocks than you might.
That's right. Exactly.
Yeah.
And, I think for retirees, it's really important to watch their nest egg very carefully. A huge bear market like in 2008 can really devastate portfolios. And it may take them a while to come back. They were fortunate that because of central bank action, after the great financial crisis, the stock market did recover fairly quickly, but it's not been the case in the past.
Yeah, we haven't had an extended bear market since 2000, 2001, 2002.
People forget.
Yeah, people forget. How are you? It sounds like you're staying pretty active in retirement. You're still researching, and I think you've got a book coming out.
That's
Tell us
correct.
about that.
Yes,
Yeah.
Thanks for mentioning that. Yeah,
Sure.
it'll be out in August. It's called A Richer Retirement, supercharging the 4% rule to spend more and enjoy more. And essentially, it's a distillation of everything I've learned in the last 30 years. And I'm able to, for the first time, put it in a nice progression of events, like a process that people, and it's written for the non-professional, where people can develop a withdrawal plan in retirement, soup to nuts from the beginning. And there's rational, scientific basis for every step along the way, and based on historical info. And I'm very proud about it. I'm just sorry it took so long to develop a process, but for years I just couldn't figure out that relationship between inflation and stock valuation and the safe withdrawal rate and be able to quantify it. Finally, it just hit me one morning, sitting here at this very desk. And I said, "Oh, okay, let's do that." And unfortunately, it worked. So it's in the book.
So further refinement of these withdrawal rules, distribution rules.
Yeah, it's really, for the first time, it develops a methodology where you can, just put in numbers and come out with what you want. Before it was like going to Vegas and playing the slots or blackjack. You got a chart saying, hold on 17 and hit me on 16 and hope you come out. That's a tough way to run a retirement portfolio.
That's a difficult system. How does it feel when advisors, really every advisor I know uses this rule, and it's come from your research? And how does that make you feel? Are you proud of that? Are you a little? How do you feel about that?
Well, it's neat. Yeah, sure, I enjoy that, but also, it reminds me of the awesome sense of responsibility I've created myself to get it right. You
Yeah.
know, that's why I spent so much time and didn't rush to publication until I was sure I had something really that I felt confident in. You know.
Yeah, yeah. And then after you published your initial paper in 94, I think there was a study that corroborated it. It didn't mention you, but it's called the Trinity study.
Uh-huh.
Talk about that.
Well, honestly, you know, I'm aware of the Trinity study. I know that their results were essentially identical to mine.
Yeah.
Beyond that, I really don't know too much about the folks who authored it. I remember writing a letter, and I can't remember getting a reply. So it was, for me, great confirmation because, quite frankly, for a while there, I was the only guy out there doing this, and it just scared the hell out of me. What if I made a mistake, you know, in my spreadsheet in the third column and the fourth, and boy, everything, it's not 4%, it's 2%. You know, that would be a disaster.
Right.
I used to have nightmares about that, but that Trinity study gave me a lot of breathing room. You know.
That's great. Yeah. I'm sure it was a big relief that you had some independent corroboration when it came out.
Yeah, that's really important to have that in science.
Yeah, definitely. What else? Anything important I left out at this point, or anything you want to add? Anything about the new book, maybe?
Well, in a book, I talk about, you know, it's not just about a number. It's about having a withdrawal plan. And if you have a plan, a long-range plan, whatever it is, an estate plan, investment plan, insurance plan that runs out for that length of time, you have to be prepared that something is going to go wrong in the middle of the plan, something unanticipated, and be prepared to make a mid-course correction. And I spent a long chapter discussing various scenarios that may occur in retirement. Maybe I'd just like to mention two quickly, if we have time for that.
Please, take your time.
Sure. The first scenario I looked at is one where a retiree encounters a bear market unexpectedly, early retirement, and it's fairly deep. And when he looks at his portfolio, it's trending well below, you know, the model, the template that he sent up for himself, that he was going to measure himself against.
Yeah.
So that his withdrawal rate now, instead of being maybe 6%, is now 11%, or something like that. And it's really scary. The question is, how should you respond to that? And what I explored first was the option of doing nothing. And it turns out doing nothing, if you're just dealing with a stock bear market, is the best option because stock markets come and go, bear markets come and go. They hurt the portfolio in the short term. In the long term, there's a good recovery, and that's what happened here. And within 5 years, this person was back on plan without having to do anything. So it paid not to panic in that circumstance. The second case was one where they also encountered a bear market early in retirement, but on top of that, very high inflation developed out of nowhere, you know, 8, 9, 10%. And when they tried to use the same strategy, they found out that after 10 years, they were still way behind plan. Even though the stock market had recovered, inflation was forcing their withdrawals so high, so rapidly, it was just chewing up their portfolio.
Yeah.
They had to take an emergency measure in the 6th year, let's say, of the 30-year retirement by cutting their withdrawals almost 30%. And not many of us in retirement can withstand that kind of hit without a major change in lifestyle.
Sure.
And it's just two lessons from that. One, you know, if you're facing inflation and it looks like it's going to be persistent, it's going to be high, it's probably a good idea to panic in terms of reacting to it and cut your withdrawals almost immediately until the storm passes. It may not pass, you know. And the 70s was an awful example of that. And the other, just in general, inflation is the worst enemy of retirees. It's even worse than big bear markets and stocks because what's the likelihood after, you know, 10% inflation for a number of years, you're going to have 10% deflation? Probably not going to happen. So whatever withdrawals increase to, they're going to be stuck there, and it's going to affect you for the rest of retirement. So.
And that's why that 60s period was the worst period, even worse than the
awful.
30s.
70s, devastating for retirees.
Yeah. Since people are worried about inflation, even though it's certainly not at 9% anymore the way it was in 2022, inflation does seem, in 2022 we had a stock market that was down big. We had a bond market that was down 13%, more
Unusual.
than in anybody's memory for investment grade bonds to decline that much. Is there anything that is commodity exposure, oil producing stocks, something that investors can add even just gently to their portfolios that could give them some greater sense of safety, that if inflation really gets out of hand, they're covered in some way?
Well, I guess the traditional measures have been gold and commodities, maybe TIPS, Treasury inflation protected securities might help.
Yeah.
I'm not sure anything is completely helpful in a 10% or 12% inflation environment. You're probably going to suffer no matter what.
Yeah.
Unfortunately, can't control that. So, I advocate doing the things, controlling the things you can control, which is your portfolio allocation, to get in a position where it's not being damaged as much, and by reducing your spending, because that you can do immediately. Even though it's painful, it's a measure you can take that will help.
Yeah.
Certainly.
Yeah. I've been thinking a lot about tips lately. We had a podcast with journalist Brett Aarons on tips, and some of the longer term tips were trading at 2.5% plus CPI. They're probably not there anymore. The bond market's rallied recently, but I'm curious if you've thought about redoing the study. There's not a lot of history on tips, and the studies you do are historical, but not sure how to ask the question, but if you've thought that tips could be a really good addition at this time when they're guaranteed to give you inflation plus something else, plus something positive above inflation.
Yeah, tips. I have a long research list of topics, and tips has worked itself up right near the top now. So it'll probably be the next thing I do in my next cycle of research, because a lot of people have asked me, as you have, about that. And there's a problem with them having a short, historical record.
Yeah.
But maybe we can look at the last 30 years or so and find something meaningful that will help guide us. See how they performed in various conditions. Just that we haven't had enough variable conditions over the last 30 years to really put them on the racetrack and run them through all their paces. But
that's right.
Might learn something for what we know.
Yeah, and that's how long they've been around, about 30 years, and we just haven't seen too many diverse environments in those 30 years. We haven't seen inflation except for 1 year, really.
Yeah, that's right.
To see how they'll perform. I'm a little curious about real estate. I think you said you added that, and that's thought to be an inflation hedge in some ways, but it also didn't perform well, partly maybe because it was just plain overvalued, but partly because real estate companies run with a lot of borrowed money, and so when it costs more to borrow money, inflation can hurt them too, even though they can raise rents.
Yeah, I haven't added them yet. It's another area to look at. Once again, it's an area. I think REITs have probably only been around 50 years or so.
Something like that. I think
that's
that's
about
right.
half the database that I have. So.
Yeah.
Traditionally, real estate has been an inflation hedge. I don't know if holding REITs is the most efficient way to do it, as opposed to buying a piece of property and renting it out.
Sure.
That may be. That's probably right number 2 after tips on my research list.
Okay, very good. So I'm hitting all the things that have moved to the top of your list.
Anticipating well.
That's a good sign. Thanks. Anything else, Bill, before we sign off? Anything you want to leave investors with, retirees especially?
No, except they need to develop a plan, probably with the help of a professional. But either way, they need to have a plan, and they need to have the courage to stick to the plan unless it's clearly indicated that the plan needs to change. And hopefully, what I've said in my book will provide some guidance as when those circumstances arise.
Yeah. So have some flexibility in retirement. I think you're more a fan of buy and hold and keep things steady when you're in savings mode, but have some flexibility in distribution mode. Is that Is that a fair
You
way?
really think you need to, because preservation of capital, I think, is the most important factor. It's much different from, the pre-retirement when accumulation of capital is your primary goal as fast as possible.
Yeah.
Here, if your nest egg drops below a certain critical level, critical mass, you may never be able to get it back to where you need to generate the income that you need. So you have to be watchful, mindful.
Okay. Be careful in retirement. Have more flexibility.
Yeah.
Bill
Otherwise,
Bengen,
have a good time.
otherwise, have a good time. Enjoy
Yeah,
enjoy
yeah.
your money after you've spent it, after you've saved
That's
it.
so important. So important.
Yeah.
Enjoy the money.
Yeah. Bill Bengen, this has been such a treat. Thank you for joining us. We appreciate it on Capital Considered.
John, thanks for inviting me. It was fun.
Thanks so much.